Good morning, ladies and gentlemen. A big warm welcome to our AIMA webinar this cold Monday morning in Hong Kong. This morning we are kindly hosted by Diginex. The title of the webinar this morning is The Future Evolution of the Digital Asset Industry, and specifically looking at regulation, correlation, and of course, value. There's clearly been a lot going on in the digital space, so we have a very timely update before we close out the year for you. Interesting, the registration for this morning's webinar has been very, very strong, which obviously anticipates what's going on in the background up until now. As usual, we have the AIMA in-house rules, two obviously being the most important ones. Firstly, we're under Chatham House rules. And lastly, all the views expressed this morning do not reflect the views of AIMA or its membership at large. With that said, we have a fantastic lineup of speakers this morning with yards and yards of experience. We are moderated by someone well known to all of us, Mark Brady, a digital asset expert, who will kick us off and do the introductions and get us underway. Over to you, Mark.
Thanks, Michael. Good morning, everybody, and welcome to this seminar. Today we have a very esteemed panel of digital asset experts, and what's very nice about this panel is that they each represent a different aspect of the digital asset ecosystem. First is Avanish Aquila, CIO of Orano Capital. Second is Neil Sheppard, COO Financial Services Diginex. And last but not least, Scott Thiel, partner DLA Piper. If you folks could start your cameras and we can kick off with the first question. I think anyone aware of digital assets in the last couple of weeks is very aware of BTC and reaching all-time highs. I think the first question today has to be to each of the panelists, what do you think is driving the market? Is it sustainable? Who is buying? Who is selling? And how is this different from 2017? Ab, do you want to kick off this question?
Yeah, sure. Thanks, Mark. And thanks for having me today. Yeah, there's a few things I think I'd like to point out on this topic, which is, that there's clear cycles that we see with Bitcoin and the digital asset market overall. The first major one really in 2013, and then 2017, and now another one this year. And I think the first thing I'd point out about this cycle versus the last cycle is, for me, there's a lot more institutional involvement. There's more real institutional inflows into the market. In 2017, it was far more speculative, whereas this round we've seen like real inflows from corporates, and we're seeing real money managers and some serious heavyweights within the hedge fund business start to talk about the benefits of Bitcoin as a store of value asset. And so I would point to the 1970s, like 1971, up until that point, gold had basically had 50 years of trading between $25 and $35. And then when the US dollar broke away from gold, gold went up from like 35 to 180 within 3 years. And I think there's some similarities in terms of what's happening with the overall macro backdrop and the way people are looking at Bitcoin and the kind of search for alternative store of values. I'll leave it at that so the others can speak.
Neil, agree, disagree?
I agree.
You're seeing different players in the market?
No. I think it's. I think most of the points that Avanish made hold true. I think it comes down to people getting comfortable with that concept of storage of value, and then secondly, also some elements of improvement in utility. If you look at those, some major payment institutions and other platforms that now accept Bitcoin as a as effectively as a trading currency, also sort of changes the basis, not only from the institutions that are looking at it, maybe as an anti-inflation hedge or as an alternative asset investment, storage of value, but then also for individuals who can now actually use it, generally in their day-to-day sort of retail purchases and elements like that make it different. And I think also the final piece is just around more people understand it. There's a better understanding of what it's doing, what it's trying to do, and what its sort of use case and purpose is. And from that understanding comes a significant increase in credibility, not only from people being aware of the benefits as well as the any possible disadvantages they see, but also from seeing other institutions, be it institutional investors or companies that now allow it, sort of all build towards that narrative around getting people comfortable with it. And with that, that's what seems to drive that supply-demand dynamic that we also know that is very restricted on one side of that equation.
We'll have to get into the Spider-Man dynamic later in the panel discussion. I'm very interested to hear more about that. Scott, your thoughts about Bitcoin and the price volatility we've seen recently?
Sure, I think I agree generally with that. The comments made. I think there's elements in that. Couple of additional observations. I mean, I think we've just experienced a flood of quantitative easing from global governments around the world. It could be coincidence, but the last time there was a very significant, the first real spike in crypto asset prices coincided with the aftermath of the global financial crisis and a similar process of central bank money printing, for want of a better word. So I think that money is looking for homes. It's looking for homes that have potential upside. We're in a low inflationary environment, so there are challenges to find maybe traditional investments that are performing well, particularly with the uncertainty. So I think there's elements of liquidity looking for a place to go in the first instance. Picking up on Neil's point about, and I think this is an important one, we're beginning to see user experience. People are beginning to, and I think it's still very early days. I mean, my observation would be that mainstream adoption of cryptocurrency is still elusive because of the challenges of the user experience. What is this hardware wallet they speak of? Am I really comfortable that I've got private keys stored on a mobile app on my phone, and what happens when I lose them? What's happening to all these stories about losing assets? And custody solutions are improving. We're certainly seeing more self-storage solutions in the form of more user-friendly hardware, cold wallet storage solutions with biometric access and various things like that. And I think that's beginning to give people comfort about doing themselves. Perhaps more importantly, particularly at the kind of institutional level, is the rise of regulated custodians and the ability to effectively provide something that looks, to all intents and purposes, like a bank account, but this is for cryptocurrencies and indeed perhaps security tokens as the market evolves in that direction as well. So I think that usability and the user experience is maturing. People are getting more comfortable. We're seeing more sophisticated on and off ramping, even at the retail level. We're seeing in many markets that you can buy crypto through a credit or debit card, fiat on ramp, which is allowing people at home to play in a way that they perhaps weren't. So that kind of ease of access is also a relevant factor. The other thing I think I'm seeing in terms of projects that we're working on and client areas of business development, and it probably reflects the fintech market generally, where if I look at the vast majority of fintech projects we've been involved on, at their core is a payments or remittance solution. That's been the bulk of a lot of the fintech projects where we've actually seen meaningful revenue generating projects. And again, in the context of crypto, it's the same. We're seeing the use of cryptocurrencies to streamline remittance, either to help manage foreign exchange risk or cross-border storage of value flows. Efficiencies in terms of the associated, conversion and cross-border payments and all of those things that come with it. So definitely we're starting to see, not just Bitcoin, but indeed a number of the currencies being used in a way to facilitate more efficient payments solutions. So a combination of things is my answer.
Okay, that's great. One thing you mentioned was custodians, and I think the regulators across the globe, one of their top concerns, and this is not just with digital assets, but across all asset classes, is protection of the retail class. To my knowledge, there's no actual licensing scheme for digital assets for custodians. Av, do you want to just talk a little bit about how you approach the custody space for your funds, and what were your concerns, and were these allayed, or are you still worried about the space, and how do you see the regulators interacting with custodians?
Yeah, so I mean, more broadly speaking, when we think about regulators' concerns, the number one has got to be investor protection, and so that's very wide ranging from ICO issuance. That obviously needed to be cleaned up, and so I think the regulators now view even a decentralized project like Ethereum at the beginning. They view that as a security that's an enterprise driven, or there's like an entity that has to kick off these projects. And so also the safekeeping of the assets, which is the custody part that you mentioned. And when it comes to our funds, obviously we need to be incredibly careful about how those assets are transferred between the counterparties, but also how they're stored, and actually what percentage held in cold wallets versus hot wallets. And so in terms of like operating a regulated fund, or being a regulated manager operating a fund, we would keep a high percentage of the assets in cold wallet custody. And I think that's, and then you've got to find sort of creative ways that you can trade against those assets, and so that you're not disadvantaged from a trading and from a business standpoint.
Interesting. Thanks, Av, for that. Neil, what are Diginex, your head of financial services, what are your thoughts on the custody space and how it's evolved since 3 years ago, where basically it was a hardware wallet in your desk drawer now?
So I think there's a couple of interesting points around it. We have a custody solution as part of the ecosystem that we've built, which is based out of the UK, and the FCA have started to provide some regulatory framework that we're in the process of working with. I think there's a fundamental difference between custody for virtual currencies and then custody for digital assets. And we need to sort of bear that in mind. One's a true bearer asset, and it's about safeguarding and safekeeping of those assets. And then if we look at more the digital security side, where in fact, even in traditional finance, they're not true bearer assets anymore. There's a registered list of holders, and if you lose the piece of paper that says you own something, you can speak to someone about finding it, and effectively recreating that. And similarly, if you look at the sort of standards that you have for digital securities, that same process can be put in place. So there's a difference there between a sort of segregation of duty from a regulator's perspective, and what your custodian is doing to ensure what your fund manager is doing and what you understand to be yours and being operated on your behalf is being managed correctly. And then there's the pure custody part, that is the safekeeping of those assets. And I think the custody role within digital securities changes quite a bit between looking at those two things and where your focus is. So obviously for a pure bearer asset, your focus is very much around the security of those assets. If your focus is more that segregation of duty and providing a service to the asset manager, then it's much more around, improving that process, reducing the friction, making it more efficient, which is all of what digital assets in general are trying to bring to the table. So in that sense, I think they're slightly different, but sort of the key point in both of them, and I've sort of touched on this, is really around capital efficiency. So how do I keep my assets safe, but also give me the greatest flexibility as a fund manager to be able to trade against them, move them around, or use them within a broader ecosystem? Because despite the fact that of what we've seen over the last few years relative to traditional finance, we are still quite fragmented. There's a multitude of different venues you can trade on, a multitude of different places you can work in, unlike somewhat in the traditional asset space. So making sure that you've got that concept of how I can be efficient with my assets across a broader range of platforms is also sort of a key part of how custodians are looking to work. So I think they've somewhat ticked the box around keeping your assets safe. I think there's a lot of work being done with regulators on the digital security side. And then sort of the other piece that people are now really looking at is, okay, now that we've got the assets safe and now that we adhere to our ability to manage assets on behalf of the fund manager, how can we make that process as efficient as possible?
That's great. Thanks, Neil. Scott, sort of from a broader perspective, I mean, obviously, being the lawyer here, we would expect you to be pretty up to speed on some of the latest developments from the various regulators. What are your thoughts about the effects of the SFC's latest? Is it a position paper? What are we calling it? Around trading venues and the licensing of said venues. I mean, what effect has it had on the markets in terms of retail participation versus institutional participation? And do you see other regulators globally following suit?
It's a good question, and I probably need to keep myself in check in answering it. There's it's an interesting, all of a sudden regulators are wanting to regulate cryptocurrency and cryptocurrency exchanges, and almost as if it was a new thing. Obviously, cryptocurrencies has been around for certainly a decade or more, and so it does feel like they're somewhat late to the party in terms of suddenly deciding we better regulate these. Not least of which is because it strikes me as an interesting regulator in the context of Hong Kong to even be attempting to regulate this. I would have thought cryptocurrency looks a lot like money or money's worth, which is generally the remit of the Hong Kong Monetary Authority, not the SFC. So it strikes me as a little bit curious that they are, firstly, the regulator who's attempting to regulate this part of the market. Secondly, it's taken them 10 years to do it. And I actually was probably somewhat surprised. Perhaps they're taking a lead from Singapore, and obviously in the Singapore context, we have more of an omnibus regulator, so there isn't that same division. But it's still interesting. And the other observation, and I think it's worth pointing out, obviously at this point in time, it's not law, it's a proposal, a warning, an advance notice that there is likely to be regulation coming, the details of which need to be fleshed out. You touched on retail, and again, I don't want to give a strong position because it's not yet clear, but the indications are that they may try and prohibit retail or make this another asset class for which retail can't play. Now that's interesting, and I think there was an earlier comment about how one of the primary concerns of the regulators is investor protection. Yes, of course, and that makes perfect sense. And there's a special level of protection when it comes to retail investors, and again, that makes sense. They're theoretically less sophisticated and unable to make decisions. Although there's an open question as to whether that's philosophically correct, but I get the principle. But what worries me about what the SFC is saying is they're effectively maybe suggesting that this will no longer be an asset class that retail will be able to participate in, and I have a different view potentially about protection of retail investors, and it's about locking out an entire class that isn't professional investors, and making these assets unavailable. And I think it would be concerning if it happens. Now, one thing I think will happen is very few, retail investors who want to play in crypto assets are likely to stop playing in crypto assets, even if the SFC decides that you're not going to be able to trade on an exchange here in Hong Kong. I suspect all that will happen is people will open accounts in other jurisdictions and trade offshore. And we are beginning to see that with clients saying, well, actually, it's interesting. There's a two-pronged piece here. One is that you've got some clients saying, well, we'll just move to another location, or we can operate in any number of places. So there's a risk of flight of the businesses to other markets. And I get why that's maybe not a bad thing, but it also, I think, will impact potentially the maturity of the market locally. The other thing we have seen, however, is that some of our clients are looking at, well, this is good. We now finally have some regulatory certainty coming, and that's a good thing. I now know what the rules are. I now know what sort of level of AML KYC is going to be required. I now have rules of the game to which I can play. So in that respect, perhaps it will drive the maturer end of the market to be more sophisticated and actually set up shop in a way that's more diligent. And I think that would obviously be a good thing. I think Neil touched on it as well, though, that I think, you know, where this will get much more interesting is when we start talking about the regulation and the licensing of security tokens, so asset-backed cryptocurrencies. One thing I didn't say in the answer to my first question, but it ties into this, is why is a Bitcoin worth anything? I mean, really, you know, it's an extraordinarily difficult thing. The idea of sort of crypto economics and what should the value of a Bitcoin be, I think is probably, my gut feel is it's 99% sentiment, greed or fear, and the whales playing trading games. I mean, there's no assets behind it. There's no sovereign wealth behind it. There's, you know, it's a very difficult thing to put your finger on. And I think actually what we will see is the regulated digital securities market comes online, not only with, you know, dealer brokers, but also the digital asset exchanges will be able to handle those assets. Actually, I think that's going to be a much more interesting place, and one where we will see a much richer sort of set of products being created and then able to be traded in the local market. Just one more comment is really to pick up on Neil's observation, which I absolutely agree with, that there is this misunderstanding that all crypto assets are these kind of bearer, you know, kind of assets, that if you have the private key, you can take them. And I think we see that fear with regulators, not just here in Hong Kong, but actually with, you know, in many markets where we're dealing with regulators, that they see the stories about, you know, Bitcoins being hacked off exchanges and Ethereum going missing here and people doing bad things with these tokens. There are some fundamental differences in the way that regulated security tokens will operate. Neil mentioned a few of them, and I absolutely agree with that. The ability to sort of burn and reissue based on a subsequent kind of authentication of the rightful owner. But there are other you know, technology and, you know, pieces, including things like, you know, having whitelists. So building into, we've recently deployed a tokenization engine that we've built, and one of the things in there is a very clear whitelist. So you can't, the smart contract will not allow a security token to be traded to somebody who isn't on the whitelist, which just bakes into the code level of this asset. The fact that somebody can steal the private key, but they still can't transfer it to a bad actor wallet or to somewhere else because they're not on the whitelist. So again, there are layers and layers of protections that are actually going to be available with the kind of next generation of digital assets, which are the security tokens that you just don't get with a cryptocurrency, which is that true. If you have the private key, it's yours kind of thing. So rambled a little bit there.
That's okay. You're a lawyer. That's your job.
It is.
I'm married to a lawyer, by the way. That's why I can make
sorry to hear that.
cheap shots. Let's talk more about licensing. I want to talk about it from a fund perspective and also a trading platform perspective. So I'd like to start with Av. You are one of the few, if not only, Type 9 licensed digital asset fund in Hong Kong. I'd like to hear a little bit about how you arrived at that licensing, what extra hoops you were made to jump through, and if you think that was worth it. Do you think it's helped your capital raising or asset gathering, or do you think that it's hurt it?
Yeah, I mean, I think it's definitely helped. I mean, before I go into the detail, just one thing that Scott was talking about, which is, and I agree with a lot of what Scott was saying there. The focus in Hong Kong is on professional investors, and seemingly it looks like it's going to be tough for retail investors in Hong Kong, at least to trade or custody their assets, with licensed corporations here. I mean, the reason why regulators are taking the stance is because obviously the market's quite volatile, and there is a risk of permanent loss of capital in some of these tokens projects. We've seen that happen, and so there needs to be some layer of protection. As a licensed manager, we're bound by the rules and regulations, and so we're only allowed to onboard professional investors. Eventually, the hope is that one day there will be authorized funds that are retail funds in Hong Kong that invest in digital assets. When that happens, you know, who knows? I guess the regulators have got to be more confident about the volatility in the market, and also the network of custodians and the risk, the counterparty risks of storing and transferring these assets, right? And all of that stuff becomes better understood. But like going on to like our license, you know, we're the way the license works for a manager is there's a standard Type 9 license, which is asset management, and then on top of that, there's a 37-page document which outlines the pro forma terms and conditions for those managers who want to manage portfolios that invest in digital assets. And so you have to adhere to that additional 37 pages, which offers a framework, a broad framework on everything from how those assets should be custodized, what the risk controls should be, what the operational procedures should be, what the investor onboarding should be. And so we adhere to not just the professional investor requirements, but also the suitability checks. And the suitability checks are there to ensure that the investor is adequately sophisticated to be able to withstand the volatility and has the risk appetite to withstand the volatility that is present in this space. And then also, you know, you would expect SFC, they check our operational procedures, and they also check the counterparties we're dealing with. And so when it comes to like custodians, for example, we'll use licensed custodians, and then we'll have operating procedures which include all the normal things like wallet address whitelisting and you know, a supervision level where you've got different responsible officers that in charge of the supervisory arrangements within like the whole operational setup. And so I think, you know, I mean, I've always worked in a sort of regulatory environment, so it's not really a big deal for me. I think it's better, and you know, I think it adds more credibility to the space if we've got professional managers who are licensed.
Yeah, I agree with you. Neil, do you want to talk about? I know you guys have a trading platform that you have recently launched, and do you want to talk about it from a trading platform perspective in terms of licensing? And I know you guys are down in Singapore. Is there any particular reason you chose Singapore over Hong Kong, or you know, just sort of walk us through how you went through the process of licensing and the various things you needed to do in order to get that platform up and running?
Sure. Like, I think it starts really at a high level as to what you want your business alignments to be. So for us, right from the very start, it was always about trying to bring credibility to the industry in general. And you can't do that without adhering to the rules and regulations by which everyone else is generally operating within. So for us, you know, right the way up to becoming a listed company, and we're currently still, I think, the first and only NASDAQ listed trading platform for crypto, and the sort of approvals that we had to go through for that process, which were, you know, took time, reasonably onerous. But what I would say is that, you know, when those conversations with the SEC, that was quite interesting, is just how much they knew, how much they understood. So I don't think it's the case necessarily of regulators not understanding, but I do think it's important that through the top co level, as an asset manager, as a trading platform, it's important that we're constantly engaged with the regulator, because there is certain elements of sort of unintended consequence for a lot of the rules that they're thinking about doing or looking to put in place, and how that might impact other parts of what they were trying to stop. They might introduce other elements to it. And so for us, it's always been about that sort of concept. You know, we do have a Type 9 Hong Kong business for fund of funds, so not slightly different to what I was talking about. But again, it was about building a framework within which people are comfortable with what you're doing and can derive some trust in the process and the transparency that comes with that process. We have our trading platform that's currently down in Singapore under the, you know, we're working with the MAS, and we're operating under an exemption there on the PSA license. I think the primary, Hong Kong and Singapore are interesting. They're obviously both very well regarded, highly regarded jurisdictions in which to operate, and that was a key element for us here in Asia. I think Singapore, as Scott alluded to, tends to operate under one umbrella, even though there's different parts of the monetary authority down there. But unlike the US, that probably has too many different voices currently, and they need to align themselves a little bit better so that everyone can understand how you can operate there as a non-US company. But for us, sort of Singapore with the PSA license made sense from a crypto trading platform or virtual currency trading platform, and it's been a reasonably sort of positive experience, I would say, working with the regulator through this process, and getting the applications done and getting up and running down there. I think it's interesting between Hong Kong and Singapore how there's quite often a sort of a to and fro between, as each one takes a step forward, the other one tries to overtake it. And I think there's a healthy amount of sort of competition between the two regions with regard to business. You know, retail is the one part that everyone's uncomfortable with, be it across digital securities in general or virtual currency specifically, which is sort of odd because in general, most innovation within sort of financial products come out of institutions and higher up the chain. And here's one that sort of started at the bottom, and then we're trying to sort of turn the tables and then enforce it on people at the top of that food chain, and then see if we get comfortable somewhere in between. People have mentioned liquidity, and there's a certain sort of chicken and egg problem with the liquidity argument, in the sense that, you know, the more people you restrict, the less liquid it is. The less liquid an asset is, oftentimes more volatile it is. So you're trying to remove volatility from an asset to make people more comfortable with it, but you're trying to also do it whilst restricting people's access to it, which again is a sort of odd dichotomy that we need to wrestle with a little bit. So I think in general, the more people that are looking at regulation in incredible jurisdictions, the fact that there's been a few more sort of pathfinders along that process, and that we can lead the way for others, the fact that the regulators are constantly open to dialogue, conversation, and that we're in dialogue and conversation with them, you know, as individual companies and also as groups and as an asset class in general, generally is moving things forward, and I think that's positive. And I think it'll just be a case of continuing that evolution.
That's great, Neil. Scott, you know, we touched on Hong Kong and Singapore sort of being in an arms race to outdo one another. Including Hong Kong and Singapore, across the region, you have Australia, you have Tokyo, Japan, Korea, Greater China. How do the regulatory environments compare against? I know it's a very broad question, but, you know, are there any particular things that stand out as being unique, or, you know, such as in China where they basically shut down cryptocurrency trading? How do you sort of rate the regulatory landscape in APAC? Scott, you're on mute.
Apologies. Thanks for the question. Yeah, it's a complex one, and there is really I'll pick out a few themes regionally, and maybe also just touch on a couple of more outside the region observations as well. The arms race analogy is an interesting one. It's a very slow-moving arms race, but it is, you know, as people have pointed out, we are inching forward, I think, and particularly when it comes to the regulation of asset-backed securities, digital securities, which, you know, from our perspective, don't necessarily look like anything other than what the world already knows, in that the same laws can apply, the same disclosure requirements, the same, you know, need for appropriate you know, offering documentation and credibility of the underlying asset and the issuers and all of those good things. So I don't think anything's changed there. I think there's just this overarching nervousness about you know, digital assets generally, and I think some of that's come from the reaction to the ICO bonanza in kind of 17, where there was some questionable fundraising. There's no doubt, although interestingly enough, I'm not seeing an awful lot of investigations and enforcement and prosecutions. You know, if there really was so many illegal ICO fundraisings done in Asia, where are the prosecutions? I mean, there have been one or two stopped, but, you know, very, very little enforcement's happened. So I don't know how much of that is real versus perception. But I think that perception has damaged the market somewhat, and there is a rebuild job. I think Amish made a good observation about the need for credible regulated players. And, from our perspective as a global law firm, it is essential that these things are done well, and that we don't have a spate of offerings that are questionable regardless of whether there's digital or not. And that's the risk for digital. And something we see in our business is sometimes the people that approach us are, this is the last chance. Oh, well, we couldn't raise money, or we couldn't do something credible in any other way, but we've heard that a security token or some sort of utility token or some sort of digital raise, it's just carte blanche. And that's there. So there is that perception issue, and I do think that's coloured the way the regulators are responding to promoting this space going forward, because there is that nervousness. Whereas what we're really focusing in is on enterprise grade, highly credible projects with sophisticated issuers and excellent underlying investments. And at that point in time, the technology really becomes an enabler, where we can reduce some of the friction points. We can speed up some of the things that actually are dear to the regulators' hearts, like transparency and dissemination of information about the performance of an underlying asset. There's a fantastic way of using blockchain technology to disseminate this information in a way that just isn't currently happening with traditional assets. So there's a lot of upside to the technology, but at the moment the fear is kind of partly probably because of an understanding issue and what's happened in the past around that. Now, this is a long way to getting to an answer to your question, which is what do we see across the region? China is very much out. They ban Bitcoin or variations of blockchain technologies most weeks, just to make it clear that it's still banned. It's not only they're doing that at an asset level, but they're actually doing it at a technology level. So there are specific requirements for any distributed ledger technology use cases to be registered with MIT and various other registries. And if you go and try and register those things, you probably won't get a registration. So it's effectively they're centralizing decentralized technology, which is a very Chinese way of dealing with things. And I think what we will see is the emergence of a Beijing controlled blockchain technology solutions, including their central bank digital currency, which the digital yuan. And I think that will be an extraordinary project and will in many ways wake the world up to the fact that currencies have already been digital for a while. We just haven't noticed it. But the Chinese will do it in a way, and using blockchain technology for, there are lots of questions about will they use that for tracing, and and I think the answer is yes, and the technology allows that. But that's certainly going to be interesting. But at the moment, for things like digital assets, China is really a no-go market. Japan is coming online slowly. Again, we've been supporting clients with their cryptocurrency exchange licenses, their activities, the issuance and storage and custody of security tokens. We've been helping a recent US issued security token move into the Japanese market. And, there are certainly ways of doing that now. It's still quite nascent, but it's certainly a market that's open. South Korea has always been a market leader, probably more a market leader in terms of tech rather than the regulation, but the regulation is following. Places like Malaysia and Labuan in particular were very early to license a number of digital asset exchanges, for example. We've had some conversations with those players, and the market is slowly maturing, but it's been quite slowly. But it feels quite a permissive environment, and they've gone and licensed. The problem in those markets has been, I think, the access to credible projects and credible assets and liquidity that then comes off the back of that. So they're probably some of the the highlights. In terms of Singapore and Hong Kong, they are mature, but they're mature compared to the rest. But actually, there are impediments. So when you get a digital exchange license, and there's for a regulated asset, they have rules like, well, you can only list that asset if it's got a year or 2 years of stable trading history. Well, we're in a brand new world with brand new security tokens being only coming online now, and then you have to wait a year or 2 years potentially before you can list them. And different, I'm generalizing, but there is this sort of requirement. And yet the regulator's been focusing on digital exchanges. That's where they've spent the effort, particularly for security token trading, spend all of their effort on these exchanges rather than the issuance and distribution side. And then once licenses are granted, these exchanges will sit there going, sort of twiddling their thumbs, waiting for assets to be created unless they look at foreign assets. That is another feature, and why I do want to just mention the global jurisdictions, because what we are beginning to see is people in different parts of the world who are able to either do a distribution or to host a security token in particular on their exchange in one part of the world or the next, irrespective of where the asset is and irrespective of where the investors are. So we take something simple like a single piece of real estate. You could have a piece of real estate in one part of the world. You could have investors from all over the world. And you could do an issuer over here where the broker dealer in that particular market is able to actually onboard investors from anywhere in the world in accordance with local rules. And then that token, once minted, could then be put onto a digital asset exchange somewhere else. So because of that need to knit together these projects from kind of inception through to the secondary market liquidity piece, we've been building up our network of partners who can do this in different markets. And I want to make reference, I was speaking at the Abu Dhabi FinTech Week last week, and indeed I was there in person again last year. The ADGM is a market that is really pushing this, for example. So there are a number of regulated digital asset exchanges, there are regulated crypto exchanges, there are dealer brokers coming online. So that's a market that I think is very progressive and one to watch. I think they are watching Singapore and Singapore are watching them, is my sense. There's a bit of symbiotic regulatory relationship going on there, but it's certainly a more mature one. The UK, Switzerland are two other European markets that I think are quite well formed, and there are routes to market, even though the ecosystem is only just getting going. And the US, for all of its, the gnashing of teeth over SEC investigations and the challenges, and all ICOs are dead, which they are, I think, any crypto asset there. And I think Avinash made the point that even Ethereum in early days would be seen by most regulators and certainly the SEC to be a security asset, not a cryptocurrency asset. However, the maturity of the US market means that there is actually a number of regulated players now who can help get these projects away. And a lot of the players that we're talking to are doing both cryptocurrency assets and security token assets. And so the sort of learnings and the technology and the sort of the way the ecosystem works in unregulated land can then be translated across to helping sort of digitize the regulated piece, which requires a lot more because the regulations demand greater checks and balances and disclosures and other pieces and also licenses. But that combination of the two is really the sweet spot. And I think we are moving ever closer in some of those markets. And Canada's another one to actually seeing sufficient coalescing of the pieces so that the market takes off. I'll leave it there.
Thanks, Scott. We've sort of circled around the digitization of assets topic, and I'd like to now focus on that for the remainder of our time. We've used the word security token to describe basically putting a piece of real estate on the blockchain and allowing people to make micro investments in it, or whatever you want to call that. How realistic are STOs? Have you seen many of them? I know there was an example of a painting recently that I think they did a STO on, or something like that. Do you see these replacing cryptocurrencies, or are they going to be in parallel to cryptocurrencies?
Yeah, I think there'll be one example of like cryptocurrency. Of cryptocurrency technology or blockchain technology, broadly speaking. I always think about digital assets either being a commodity form, which I would say is Bitcoin, or being in a currency form like Ethereum, or being asset-backed, like the kind of security tokens we're talking about. In addition to that, you can also have like governance tokens as well. So I see the whole ecosystem as four different types of classes within the whole digital asset class in itself. And yeah, it's very convenient and it's very secure to represent the ownership rights to an asset in a token form. And there's a bunch of different examples. Like there's Pax Gold, which is being used as a stable coin, which is like fully fungible with like physical gold. You can argue that is a much better way of representing gold ownership, a much more efficient way of representing gold ownership compared with, like your traditional ETFs, for example. And, there is, I think like the highest volume in terms of security token secondary market is T0 in the US. I think they're like over 95% of the total secondary market for security tokens. And they recently tokenized the St. Regis Aspen. So that's the first, again, I'm not sure, you could argue, well, what's the point? Do people, do accredited investors really want to be able to trade this fractional ownership in like the St. Regis Aspen? But yeah, there's definitely, I think in the real life value in this is going to be in everyday stuff. Like, I want to sell my car to you, Mark. The ownership rights of that car can be in token form, and all of the information relating to that car can be on the blockchain. So it's verifiable, and it's secure transfer. We don't need an intermediary. I mean, that's the kind of benefits that I see.
Yeah, that's a good point. One of the jewelers here in Hong Kong trademarked some technology where they actually have a stamp on their diamonds, which is linked to the blockchain, which has all the various diamond certifications on it. It's a pretry cool project, and I think you're right. The sort of everyday use is where it's really going to shine, and instead of tokenizing a famous painting or something. Neil, thoughts?
Yeah. I mean, the way we think about it and the way I think about it is there's a sort of the broader concept of digital assets, which virtual currencies and then digital securities maybe are a couple of sort of broad buckets to put things into. I'd echo a couple of points Scott made. Just making a project a digital product doesn't make a bad investment a good one. I think that was a lot of the problem that came around within sort of the ICO space. It wasn't because the format that they were being disseminated in. Ironically, it was demonstrating the value of that format because the barriers to entry, the ability to get a deal done was shown to be so much easier that people could go ahead and do it, albeit in an unregulated way. But ultimately, the reason they lost money generally was because the projects underlying it were, putting the forward aside for a second, where the projects underlying it were just really poor business projects. And so I think part of what will help resolve that situation is those, the process of the capital markets business, a lot of the DD required to sort of find a good quality project that you can then bring to market is really what will be the difference. And, the advisory process that comes around how to design and build, a form of investment that, is of value to people will be a key part of it. There's a number of different examples. I've mentioned the Aspen one. There's also been digital bonds, there's digital representations of equity. And I think they'll be the first steps, but ultimately, if you get down to it, it's what are the true benefits that the technology brings, and most of that is in around the efficiency of the process, and some of it is cap table management or whitelisting and the ability to transfer assets between those people that are eligible to hold them, and being able to move data with that and verify the data that you have. Actually, and as I think Scott mentioned it earlier, they're all key points that the regulator really should be embracing. And it's about making sure that the regulator understands that, will be one of the reasons why I think that ultimately, for me, I think the digital securities part will ultimately overtake the pure cryptocurrency part. And I think that's probably where we end up, but we're not there yet. And at the moment, we're lagging behind because you require a lot more agreement from regulators and a lot more oversight with regards to securities laws and rules. I also agree with Scott's point that in reality, it's just a representation. Certain regulations or certain regulatory bodies looking to rewrite securities law. That's probably more because the securities law in general is probably outdated, rather than necessarily, and this is a good sort of tipping point for them to say, okay, we need to rethink how we've put all of this into law in the first place. And then there's other jurisdictions that have just said, a security is a security. These are the laws that we have in place. How you guys want to represent them, how you want to, enable their transfer, how you want to provide the information. If you want to do that in a new and innovative way that is of benefit to the market in general, to the investors and to the issuer, then go right ahead. But please, adhere to the rules and regulations that everyone else who's raising and transferring capital around is doing so. And I think those are the sort of the two regulatory environments that we're dealing with, and we're sort of comfortable working in both, if you like. So in that sense, I think there's a huge amount of opportunity. There's the element of taking sort of real assets that we've sort of touched on and allowing the transfer of those. Then there's, I've touched on it, and sort of the concept of the enterprise blockchain feeding into an asset, and how you can verify, information ownership, be it from a car, as was the example given, or even through, any process of inventory management, or how an asset moves through its sort of its life cycle. There's all elements there that then could feed into digital assets and provide greater opportunity to invest at different stages. And if you take, for example, gold, whereby you might have a gold-backed token that was discussed earlier. If you take that example all the way back, you could have those verified gold reserves in a mine, and what would you pay for them to get them out of the mine if someone wants to sell it forward? There's the gold that's going through the process of being turned into, raw extract from the earth through the, the smelting refining process, and then being transferred to a vault. At each stage through that life cycle, there's probably a different discount that people would pay before you could have your hands on effectively straight transfer pass-through of gold, and giving people the opportunity to invest with all those varying degrees and quite a large analog of varying degrees of risk is really a great opportunity for investors to say, okay, I want to pay the spot price for gold because I want to be able to exchange this token for gold at any time. And someone else saying, well, actually, I'm prepared to, buy gold at a serious discount, but I'm going to take the risk that they've got to get it out of the ground and get it into the vault first, and then all the stages in between. But the technology will allow you to verify each stage of that process. And that to me is where it starts to get really interesting.
That's some really good points, Neil. I think you made the quote of the webinar, technology or tokenization doesn't turn a bad investment into a good one. I think that's a really good way to frame this discussion. So I might steal that from you in the future. I've been feeding some of the questions from the panelists to you guys during the course of the webinar. So I'm not going to turn to a traditional Q&A here, because we've been able to answer the questions that have popped up. What I'd like to do is put you guys all on the spot, starting with Scott, and make a prediction for 2021 in the digital asset space.
I think 2021 is the year we are going to see the hockey curve stick of security token offerings spike upwards very significantly. I think we will see asset-backed security tokens make cryptocurrencies look like a sideshow very, very soon. I think they will be useful as oil that helps run the machine, but as an asset class, it's always going to be relatively small. And I think what we'll see in 2021 is the beginning of the creation of the digitized, real asset economy begin to grow and take off.
Avanish?
Yeah, I mean, I think what we're seeing, I mentioned it earlier, where there's real institutional involvement now, and there's an institutional allocation of capital to this space, and I think that's going to continue. And so, it depends on whose measure you look at, but 150 trillion of managed money in pension and endowments and private wealth and asset management platforms and stuff and so on, unlocking even a small percentage of that is definitely going to grow the market. Now Scott believes most of that capital will go into the security tokens market. I would just point out that when we look at the whole digital asset space, you've got about 65% of that at the moment in Bitcoin, the market value. I mean, that is the scarce asset within the whole asset class, and the rest of the asset class has basically infinite supply. Now, obviously, if there's asset backed, I mean, let's not forget fiat currency backed stable coins are also, an asset backed form of asset backed cryptocurrency, right? So, but yeah, there's some scarcity when you've got asset backed assets. But in terms of like the overall market, if there's inflows coming into the market, then I definitely would assume Bitcoin's going to participate in price upside just based on the demand supply dynamics.
Neil, do you want to take us home?
I'll do my best. I think to me, it's about adoption. And that kind of covers both what Scott and Ab were talking about. I think we'll see greater adoption. I think that we'll see more institutional capital. For every Guggenheim or Druckenmiller or Tudor, there's a multitude of other funds that are currently looking at doing the same thing. So I think there's going to be broader adoption in general. That'll see, I think, a lot of the arguments that Avanish put forward sort of playing out. But I also think that adoption ties into what Scott said, and we'll see greater and greater movement of capital and deals into the sort of the digital security space. And then I also think that adoption will include things like CBDCs, and we'll start to see those start to become not just projects that people have talked about, but actual real life usable examples of sort of mainstream adoption, if you like, and government backed support for the technology itself. And obviously with all of that will then come through the arguments as to whether or not you support, the value proposition that the Bitcoin and other cryptocurrencies put forward, and then also can see the true benefits that the technology brings to the security space and how you can start to provide more innovative solutions to sort of capital raising and investor participation within the broader capital markets business.
Wonderful. Thank you, Neil. I want to thank all three of you for participating today and sharing with us your thoughts about the digital asset space. We covered a lot of ground today, but we barely scratched the surface. So I think we'll be having many, many more of these as we get into 2020-21. With that, I'll turn it over to Mr. Bugle, who will close today's session.
Thank you very much, Mark, and thank you very much, panelists. That was a very quick hour, which nicely wraps up today's very, very handy webinar. I hope everyone feels nicely up to speed in the digital asset world and what the future looks for us. It really leaves me to thank our speakers and moderators for their insights, which I think were very, very comprehensive. Thank all four of you for that. And should anybody want to get in touch with our panelists and moderator, their details should now be up on the screen. If not, clearly AIMA will be very happy to pass the numbers and the email addresses. There will be a replay of this hour out in about an hour or so on the website. So please get in touch with us or feel free to download it yourselves. Lastly, but not least, thank you all AIMA members for dialing in today. That'll be it for this morning's session. Please be safe, stay healthy, and test negative. Good morning. Take care. Bye-bye.